JJ Kinahan, in February, TD Ameritrade's Investor Movement Index, the IMX, was down slightly. What happened? Can you explain it?
Sure. I think primarily if you look at how the index is calculated, it's calculated with a volatility factor, and the stocks that our people were buying were actually less volatile than the market overall was in February. So it's interesting because our clients were a net buyer of stocks. They just chose to buy some stocks that weren't quite as crazy volatile as we saw, particularly early in the month in February.
Well, they were buying Amazon and Google, the A and G in your FANG stocks, although Google's Alphabet, we'll leave that aside for now. Why were they buying those two names?
Well, I think a couple of reasons. Number one, if you look at Alphabet, it got down to levels that we hadn't seen since October. It has rallied since then, so I think they viewed that as an opportunity. And again, the overall retailers, whether they be online, brick or mortar, did get a little bit beaten up. And I think longer term, many believe in the online retailers.
They were also buying Apple. Now, Apple, it's not a FANG stock, and Tim Cook was in the news a lot, but it wasn't about over a new smartphone. It was more about the encryption debate. So why were they buying Apple?
Well, I think, all that aside, I think the bigger thing is Apple is under $100. And when Apple gets under $100, it becomes very attractive to a lot of people. You have to remember, from a retail point of view, Apple is the #1 traded and the #1 held stock at our firm. So Apple is a stock that's followed very, very closely by our clients. When it does get under $100, I think a lot of them become attracted to it, whether it be just as a trade or a longer-term play.
Well, in terms of net sales, let's talk about the flip side. The telecom giants, they were net sales in February. We're talking about AT&T and Verizon. Why were investors pushing these out of their portfolios?
Well, I think it's interesting. To me, this is actually a great story for retail, and it shows the intelligence of people. We saw our clients start to accumulate those the last 2-3 months, and overall they have, as you know, Greg, really attractive dividends, which I think was their original appeal, as we see the chance of rates going up less and less as 2016 started. But what then really became interesting is they hit 52-week highs. So our clients, many of them were like, why not just take this profit? If they sell back off, I have another opportunity to get back in.
All right, and then finally, in terms of net sales, a lot of retailers. Now, people were buying Amazon, the biggest e-commerce retailer in the world, but they were selling things like Walmart and Macy's and Target. Why is that?
Well, I think the brick and mortar retailers actually did fairly well throughout February. But again, going back to what I talked about earlier, I think the online retailers are more of a belief type stock in our clients' core. They have some brick and mortar. Brick and mortars did well, and I think they use that as an opportunity to lighten their load, so to speak, on those where they had taken a little bit of profits. Because again, longer term, as we know, some of the costs that go with brick and mortar could be a little bit difficult to sustain.
Well, trading in February was definitely a V. It really came in like a lion and it came out like a lamb. We'll see what happens in March. Thank you, JJ Kinahan.
Always a pleasure, Greg. Thanks, buddy.
And thank you for watching The Street.